Ethan and Daniel are both 30 years old. They both live in Dallas. They both earn $75,000 a year. They both have steady jobs, no debt beyond a normal mortgage, and they're both finally ready to start building wealth. On the same Friday afternoon, they each make what they believe is the smartest financial decision of their lives. Ethan commits to investing $500 every single month into a low-cost S&P 500 index fund. Daniel decides to wait. He tells himself he'll start investing later, after he feels more financially comfortable. For now, he keeps that same $500 each month, sitting in a regular savings account earning almost nothing. 5 years later, both men think they made the smarter choice. 10 years later, they're even more convinced. 25 years later, the gap between them is so large that it changes what retirement looks like for each of them. But here's the strange part. Neither decision looked dramatic at the beginning. There was no lottery ticket, no six-figure promotion, no lucky crypto investment. Just one small decision repeated every month. And that's exactly why so many people underestimate it. Today, we're going to follow both of these lives year by year, using the same starting salary, the same city, the same monthly contribution, and the same timeline. No tricks, no cherry picking, just math. Because feelings and math are two very different things. Ethan opens a brokerage account and chooses a diversified S&P 500 index fund with an annual expense ratio of about 0.03%. Every month, $500 leaves his checking account automatically. He never has to decide whether to invest. The decision was already made once. Daniel leaves his money in a traditional savings account. He likes seeing the balance grow without worrying about market crashes. It feels safe. It feels predictable. Watching cash accumulate gives him peace of mind. Emotionally, Daniel feels like he's winning. Nothing goes down. Nothing looks scary. Ethan, meanwhile, watches his investments fluctuate almost immediately. Some months he's ahead. Some months he's behind. Headlines scream about recessions, inflation, elections, and market corrections. On paper, Daniel sleeps better. On paper. Because investing isn't about how your account feels next Tuesday. It's about what happens over decades. For this comparison, we'll assume Ethan earns a long-term average annual return of roughly 10%, close to the historical average annual return of the S&P 500 before inflation over long periods. Actual returns vary every year, sometimes dramatically, but we're looking at the long game. Daniel's savings account earns about 1% annually. Both contribute exactly $500 every month. Neither misses a payment. Neither adds extra money. Year one arrives faster than expected. Ethan contributes $6,000 during the year. Thanks to investment growth, his account finishes at roughly $6,300. Daniel contributes the same $6,000. His savings account finishes at about $6,030. The difference? Only around $270. Honestly, it doesn't feel life-changing. If anything, Daniel feels validated. Why deal with market volatility for just a couple $100? That's exactly how compound growth tricks people. In the beginning, the gap is tiny. Year 3, both have deposited $18,000. Ethan's portfolio has grown to around $21,000. Daniel's savings account sits near $18,300. Now the difference is approaching $2,700. Still not enough to change anyone's lifestyle. Still easy to ignore. Friends probably aren't talking about it. Family definitely isn't noticing, and that's what makes this stage dangerous. The results still don't look exciting. People confuse invisible progress with no progress. Year 5. This is where something subtle begins to happen. Ethan has contributed $30,000. His account is now worth roughly $39,000. Daniel has about $30,800. The gap has quietly grown to more than $8,000. Notice something interesting. Ethan didn't invest an extra dollar. He simply allowed time to start doing some of the work. Daniel saved faithfully. He deserves credit for consistency. But consistency without meaningful growth eventually runs into a ceiling. Now let's talk about something almost nobody notices. At this point, Ethan's account starts earning meaningful returns on money that previous returns already created. That's the engine. Not just earning returns. Earning returns on returns. It sounds like a small distinction. It's actually everything. Imagine pushing a snowball down a hill. At first it's tiny. Every rotation adds only a little snow. Then suddenly the snowball itself becomes large enough that every single rotation gathers dramatically more snow than before. That's compounding. Not magic, just mathematics repeated thousands of times. Now we reach year 7. Markets haven't moved in a perfectly straight line. There were pullbacks, there were rallies, there were months where Ethan questioned whether investing was even worth it. Daniel, meanwhile, never worried about opening his banking app. Safety has emotional value. No question. But emotional comfort and financial growth aren't always pointing in the same direction. After 7 years, Ethan has contributed $42,000. His investments are worth roughly $61,000. Daniel has accumulated about $43,500. Now the difference exceeds $17,000. On paper, that's impressive. Sounds great until you subtract one important reality. Neither of them can spend these gains without consequences. If Ethan sells investments in a taxable brokerage account, he may owe capital gains tax depending on his income, holding period, and tax situation. Taxes matter. They always matter. But even after accounting for potential long-term capital gains taxes, the growth advantage remains substantial. That's why looking only at headline balances can be misleading. The underlying math still favors productive assets over idle cash across long periods. Now year 10 arrives. This is the checkpoint where many people suddenly say, "I wish I'd started earlier." Ethan has invested a total of $60,000. His portfolio has grown to approximately $103,000. Daniel has saved the same $60,000. His account is worth only about $63,000. The difference is now roughly $40,000. Think about that for a second. Neither man received an inheritance. Neither launched a business. Neither doubled their salary. The only meaningful difference was where the exact same $500 went every month. Here's where psychology becomes fascinating. Daniel finally decides he should probably start investing too. But now he's starting from behind. Not because he wasn't disciplined, he was. Not because he didn't save, he absolutely did. He's behind because time is the one investment you can never deposit later. You can always invest more money. You can never invest yesterday. And that's the first major flip point in this story. At the beginning, Ethan looked like he was taking unnecessary risk while Daniel looked responsible. 10 years later, the boring monthly investment has quietly become the more conservative strategy for long-term wealth because productive assets have been compounding while cash has largely stood still. The surprising part is that the biggest gains are still ahead. The next 15 years are where compound growth begins accelerating far faster than most people imagine. The next 15 years are where the story completely changes. Most people assume wealth grows in a straight line. It doesn't. It grows slowly. Then suddenly, year 15 arrives. Ethan has now contributed a total of $90,000. His portfolio has grown to roughly $206,000. Daniel has faithfully saved the exact same $90,000. His savings account has reached only about $97,000. The gap is now more than $109,000. Think about what just happened. For the first 10 years, Ethan fought for every dollar of growth. Now his investments are beginning to earn more in a single year than he personally contributes. His annual contribution is still $6,000. But a 10% return on a $206,000 portfolio is more than $20,000 before considering new deposits. His money is now working harder than he is. That's the moment most people never see coming. They expect their paycheck to create wealth forever. Eventually, the portfolio takes over. Year 20. Ethan has personally invested $120,000. His account has grown to approximately $379,000. Daniel has deposited the same $120,000. His savings balance is about $133,000. The difference has exploded to nearly $246,000. On paper, Ethan has almost 3 times as much money. Sounds incredible until you remember one important detail. Markets don't deliver 10% every year. Some years are negative. Some years produce exceptional gains. There will be bear markets. There will be corrections. There will be periods where Ethan opens his account and sees tens of thousands of dollars disappear temporarily. That's the price investors pay for long-term growth. Daniel never experiences that emotional roller coaster. His balance barely moves. His stress level stays lower. That's a real benefit. But historically, lower volatility has usually come with lower long-term returns. Now we reach year 25, versus where the math becomes almost unbelievable. Ethan has invested a total of $150,000 over 25 years. His portfolio has grown to approximately $664,000, assuming a long-term average annual return near 10%. Daniel has also contributed exactly $150,000. His savings account has grown to only about $170,000. The difference is close to $500,000. Remember, they earned the same salary, they lived in the same city, they saved the same amount every month. The only difference was where the money went after payday. This is the part nobody talks about. People love bragging about investment returns. They'll say they earned 12% last year or doubled their money during a bull market. But those headline numbers leave out the hidden layers that actually determine long-term wealth. First, inflation. Even if Daniel's account balance increased every single year, inflation quietly reduced what those dollars could actually buy. A savings account earning 1% while inflation averages closer to 2% or 3% over long periods means purchasing power slowly declines. Second, investment expenses. Even low-cost index funds charge management fees. Fortunately, broad market index funds often have expense ratios measured in just a few hundredths of a percent. On a $500 monthly investment, that cost is surprisingly small compared with the potential growth sacrificed by avoiding investing altogether. Third, taxes. If Ethan invests through a taxable brokerage account, dividends and realized capital gains may create tax obligations. If he invests inside tax-advantaged retirement accounts, those taxes may be deferred or reduced depending on the account type and local tax rules. Account selection matters almost as much as investment selection. Fourth, behavioral mistakes. Research consistently shows many investors underperform the funds they own because they panic during market declines and chase performance during market highs. The market doesn't usually hurt investors. Poor timing does. Fifth, opportunity cost. Every dollar sitting idle is a dollar that isn't participating in future compound growth. Opportunity cost never sends you a bill. It simply shows up 25 years later. Finally, time. Nobody can purchase more of it. You can borrow money, you can refinance debt, you can earn a higher salary. You cannot buy back the first 10 years you chose not to invest. Now, if I only showed you the downsides of keeping cash, I'd be doing exactly what so many investing influencers do. Cash has important advantages. An emergency fund should not be invested in the stock market if you'll need it next month. Money for a home purchase within the next few years usually belongs somewhere much more stable than stocks. And investors who panic and sell during every market decline may actually earn less than disciplined savers. The winning strategy only wins if you stick with it. There are also situations where Daniel's approach genuinely makes more sense. If someone expects to buy a home within 2 or 3 years, preserving capital may be more important than chasing higher returns. If someone has unstable employment and needs maximum liquidity, keeping additional cash reserves can reduce financial stress. If interest rates on savings accounts temporarily become unusually attractive while expected investment returns remain uncertain, the gap narrows. And if someone carries high-interest credit card debt charging 20% or more annually, paying off that debt first usually delivers a guaranteed return that's difficult to beat elsewhere. The point isn't that investing always beats every alternative. The point is matching the tool to the job. Now, let's ground this in real data. According to long-term market history compiled by S&P Dow Jones Indices, the S&P 500 has delivered approximately a 10% average annual return before inflation over many decades, although individual years vary dramatically. The Federal Deposit Insurance Corporation, or FDIC, insures eligible bank deposits up to statutory limits, providing safety for cash savings but not higher long-term investment returns. The Internal Revenue Service also provides contribution limits and tax rules for retirement accounts that can significantly improve after-tax investment outcomes when used correctly. Those aren't opinions, they're simply facts. So what should someone actually do? Start with step 1. Build a cash emergency fund covering roughly 3 to 6 months of essential expenses before investing aggressively. Step 2. Automate your investing. Don't rely on motivation every month. Set up an automatic transfer immediately after payday so investing happens before you have a chance to spend the money. Step 3. Increase your monthly contribution every time your income increases. Imagine Ethan received a raise after 10 years and increased his investment from $500 to $700 per month. That extra $200 each month could add well over $200,000 to his ending portfolio over the remaining years depending on future returns. Small increases become enormous over long periods. Now let's go back to where we started. Ethan and Daniel both walked away believing they had made the smart decision. Ethan believed patience would eventually reward him. Daniel believed waiting until life felt more comfortable was the safer choice. Neither decision looked dramatic in the beginning. Neither attracted attention from friends. Neither changed their lives overnight. But only one of them allowed time to become an investing partner. The real trap isn't investing. The real trap isn't saving cash. The real trap is making financial decisions based on headlines, fear, or someone else's opinion, instead of running the numbers for your own situation. Because once you actually run the numbers, the answer often looks very different from the story people tell. And if you're wondering what happens when someone combines disciplined investing with increasing contributions every single year instead of keeping them fixed, that's a completely different conversation. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.